Good afternoon, ladies and gentlemen, and welcome to the K3 Capital Group PLC Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to John Rigby, CEO, and Andy Malborn, CFO of K3 Capital Group PLC. Good afternoon.
Good afternoon. Thanks for the introduction.
Good afternoon.
And welcome, everybody. We'll crack straight on. We've got a lot to get through here in the presentation. Hopefully a very full presentation. The group has changed significantly in the period, so lots of information to hopefully give you. Andy, can we just move forward, please? I think just briefly introductions on myself and Andy. My name's John Rigby. I'm Chief Exec of the business. I've been involved with K3 for 21 years now, starting within the sales function of the business, moving through to sales director. I've been MD of the business since 2010, where we've organically grown the business through to 2017 when we undertook our IPO, and continued that organic growth story through to more recently in 2020, when we've very much changed the face of the group with the acquisitions that we've done, and built a platform to go on and create quite a significant professional services business over the coming years. Andy?
Hi, I'm Andy Malborn, CFO. I've joined the group, I'm in my 10th year now. Joined from an exciting start, a promising start in terms of it was relatively break-even with a view of the bigger and better strategy that I'm sure we'll talk about. Being part of this growth, being part of the aim of flotation, something I think we're all very proud of, and we can see the future being just as promising as well.
Okay, so in terms of the period on which we report, clearly those of you that might have followed us for some time will know that there's been significant changes since our last reporting period to FY20, that was to May 20. We've completed 2 earnings enhancing acquisitions following the fundraise that we did last summer, and we've transformed the K3 business from what was a 100% M&A focused business to one which, while still retaining M&A at its core, has diversified its activities and now has a high quality recurring and contracted revenue business in RAND, its R&D tax business. And it also has, coupled with that, the cyclical balance provided by the restructuring and insolvency division, the Quantum business that we equally acquired last summer. So all of that coming together provides a more stable, a more visible, and indeed a more exciting landscape for the future of K3. Equally, we remain a high margin, cash generative, debt-free group, and we're excited by the growth trajectory ahead of us. Consensus market expectations see revenues approaching 40 million, 50 million, 60 million over the next 3 financial years, delivering profits of 10.5, 14 and 18 million respectively. So certainly exciting times ahead for K3 as a group. Equally, we feel like that sort of growth and that trajectory is only the start. There's undoubtedly significant scope for us to not only grow out the 3 existing service lines, so M&A, tax and restructuring, but equally by the potential to add entirely new service lines and cross-fertilize the client acquisition strengths and methods that we have across the wider group. And again, we'll come on to a lot of that as we go through the later slides. Good news, our summer acquisitions have certainly settled in well. I guess, we are M&A advisors at the end of the day, so our extensive M&A experience, our in-depth due diligence has certainly paid off. And we've seen a successful integration into the group for both RAND and Quantum. Essentially, we bought exactly what we thought we were buying. There's been no shocks, no surprises, no skeletons in the cupboard. And we're delighted with the way that both of those businesses have settled into the group. And much of our strategy when we acquired these businesses was centered around the potential for us to cross-sell, first of all, across the group SME clients, but also for us to harness the client acquisition strengths of each of the businesses for the wider good of the overall group. So the cross-selling piece has certainly started well, adding value immediately, and the rollout of the direct marketing strategy into both RAND and Quantum together with the recent launch of our K3 Hub accountant referral network, certainly gives the opportunity for additional layers of growth over what we've already talked about. And again, we'll share a lot of information with you about that on later slides. Clearly, the pandemic, together with the multiple regional and national lockdowns, has presented some challenges in the way that we build our business. Ultimately, our brands were built on face-to-face business development, face-to-face selling. And what I think we've proven through the last 12 months is our ability to react quickly to change, to flex our business model, and to learn new ways to distribute our services out to UK SME clients. And to see all three trading divisions performing well, against significant headwinds out there in the market in general, has certainly been a very pleasing feature of the last 6-month period. Following the busy summer of acquisitions last year, we certainly haven't sat back. And following those two more sizable deals, we've continued to add to the mix of the business through both lateral hires, a joint venture, and several smaller bolt-on opportunities, all of which in turn provide additional services for our clients, additional layers of growth, and additional potential over the coming years. Again, more details will follow on later slides. But in summary, we are delighted to report a H1 revenue and EBITDA number that's ahead of initial FY21 market expectations, and equally in the face of such a difficult and challenging market, that we as a business have seen fit to repay all the furlough monies that we saw under the coronavirus job retention scheme. We've repaid all the monies received in FY21, and now obviously look forward with the hopeful success of the vaccine towards a more stable post-COVID trading environment. I'll just pass you on to Andy now to chat you through the sort of headline group financials.
This slide is high-level group financials, and I think these first two graphs quite clearly illustrate what we tried to achieve over the summer. The first one in terms of revenue, the red graph is purely M&A, that's the KBS side of the group. So here we see turnover of the 100% reliant M&A business going from 7.2 million to 8.0 million to 5.9 million pounds over the period. That, as I say, was 100% reliance on M&A. What we've achieved since the summer break was the two acquisitions. So to add on top of that, the recurring nature of the R&D tax credit revenue, and then to add on top of that, the robust nature of insolvency, we've managed to deliver 17.8 million pounds worth of turnover in the period. So we sat here today 123% up on the prior year. It's worth noting that H1 period for FY20 was to November. So clearly in the previous, in the comparative periods, this is all pre-pandemic, a normal course of business. Whereas for H1 FY21, that sees certainly the first quarter coming out of the first lockdown. So all revenue streams in the M&A side of the business coming from a standing start in terms of retainer fees and transaction fees, and clearly going into the lockdown in November as well. So we're very pleased with that result. That then flows nicely into the EBITDA line. Again, the red shows the M&A business, that going from 1 year to the next, increasing, but then going down to £2.6 million in FY21. We've managed to maintain our EBITDA margins in the M&A side of the business. This year's numbers have got the PLC costs allocated based on turnover. The M&A business has managed to maintain a 49% EBITDA margin. So we've talked previously about our low cost base and our flexible model. We've managed to reduce overheads significantly in that period by reducing our marketing spend. We'll come on to talk more about remote working over the next few slides, but a significant reduction in overheads. And equally with staff numbers, we've lost some people naturally over the period. However, with the way that we remunerate people in terms of basic pay and high on target earnings, we've managed to curb that spend as well. So high margin business. When we add on top of that, as I said, again, the M&A business with a 54% EBITDA margin and the 4-month period of ownership for Quantuma, what we managed to see is the delivery of £5.6 million worth of EBITDA in the period. That's 60% up on the prior year. Overall, as a group, we've got a 31% EBITDA margin. That's slightly ahead of the numbers that are in the market. And we believe this is now the robust, diverse nature of our group. We would expect to grow this over time. In terms of cash, we finished the period on 10.1 million. That's a 48% increase on prior year. Clearly, over the summer, we did the fundraise that John talked about before, and we utilised all of that cash swiftly and decisively to make the 2 acquisitions and cover all the costs of acquisitions. It's worth noting that all 3 divisions are highly cash generative. The M&A business, as we've talked about many times over the years, typically has around 100 or north of 100% EBITDA to operating cash conversion rate because of our prudent accounting policies. What we found is that RAND, from a standing start, being acquired on a cash-free, debt-free basis, the lead time from winning a client to submitting a claim to HMRC and for that fee to appear in the bank is relatively small. So we see that generating cash very rapidly. And the same with Quantuma, that with a targeted approach to debtors and with prudent accounting policy in terms of WIP, what we find is that the chargeable time through to billings through to cash is exceptional for the industry. And again, that's cash generative as part of the whole group. This leads us on to dividends as well. When we floated, we committed to paying approximately 80% of profit after tax as a dividend. We revised that slightly to circa 75% at the time of the fundraise. The rationale for that was that we wanted to remain broadly cash neutral over a 3-year period, whilst maintaining high dividend payouts and equally committing to the earn-out payments that are due over the next 3 years. As per our announcement this week, we're now fixing our dividend policy in line with market expectations. So this year we're committing to paying 9.1p per share for FY21, 12.1p next year, FY22, and 15.5p per share in FY23. There were two rationales for that. One is to give investors security, certainty that dividends will be paid over a period of time in quite an uncertain marketplace. And equally from our side, we see potential uplift in this performance with the bolt-on acquisitions that we're looking at, that we continue to review with the lateral hires. Therefore, with fixing our policy, any uplift that may come in performance, we can then reserve the cash on our balance sheet and look to further invest in future add-ons, bolt-ons and other acquisitions and such like. So the full dividend for this year, well, the interim dividend is 3p, payable on the 17th of March. For the full year, we expect to pay 9.1p, which will be a 22% increase on last year's dividend. Pass you back to John in terms of the group structure.
Yeah, what we wanted to show here really was the current group structure and also the ongoing building out of the core service lines since our previous discussions or since the acquisitions last summer. So in terms of the M&A business, first of all, we have our 3 core brands, which are Knightsbridge Commercial, KBS Corporate, and KBS Corporate Finance. Knightsbridge Commercial typically works in the £0 to £1 million enterprise value space. KBS Corporate works in the 1 to 15 million enterprise value space, and the Corporate Finance brand typically picks up there at 15 million, goes through to 50 million plus. We have one office, which is in the northwest of the UK, and we have about 145 staff, which are based out of that office, and equally are people that are based across the regions or all across the UK. Since the summer acquisition, we've added a buy-side service called Market Mapping. This is a joint venture that we've undertaken with, headed by the gentleman who did the market mapping exercises for ourselves when we looked to acquire within the R&D tax space and the restructuring space. Essentially a buy-side service for PLCs, private equity, family office, corporate acquirers, trade acquirers, in a search for them to unearth off-market opportunities, really. So a startup, an embryonic business, a joint venture, we have the option to acquire that at a pre-agreed level later down the line. The restructuring division, obviously the core brand there is Quantuma. Quantuma has 17 offices across the UK and 225 staff currently. And since the acquisition last summer, we've completed 2 small bolt-ons to Quantuma. Firstly, over the new year, was a business called Alchemy, which is a Cayman Islands-based restructuring, forensic accounting and asset recovery business, established by somebody known to the business over in that territory. That's since been rebranded as Quantuma Cayman. but a very low-cost way of us gaining a foothold in that territory and allowing the brand of Quantuma to compete and pitch for some of the more complex and larger work that requires people on the ground within that jurisdiction. More recently, the completion of a small insolvency business in Essex called Aspect Plus. Again, that's been rebranded as Quantuma since that acquisition. And that brings 1 director, 9 technical staff, and about £1 million worth of fee revenue into the group. On the tax division, obviously Rand is our core brand there, based out of Derby, 1 office down in Derby with staff running into the mid-20s. And as announced alongside our results on Tuesday, we've recently completed the acquisition of Intax, which is a tax investigations business, just to broaden out the services within the tax division. Intax was a business founded back in 2013 by a lady called Jackie Fleming. Previous to that, she was 17 years in HMRC as a tax inspector. But a business which brings, again, around £1 million of revenue, Jackie plus around 9 technical staff. And we've paid a very sensible multiple for that business at 3.25 times multiple of profitability, and structured in a very similar way to the Rand and Quantuma deals, with a percentage paid in cash, a percentage in shares, and a percentage in earnouts. Okay, Andy, you just flick to the next slide. What we wanted to show here really is expand a little bit on the prior page and consider the broader strategic direction of the group. We certainly feel like we've now established a platform from which we can go on and build a significant group of complementary professional services businesses that service UK SMEs. We have a short-term goal of reaching 25 million EBITDA and a more medium-term goal of aiming for 50 million plus EBITDA. And some of the areas that we would see as and consider as being strategically sensible in terms of building out the divisions would be as follows. So we've got the core brands around the centre of the diagram. We've got the recent additions that I've just talked around in terms of market mapping, Intax, Alchemy and Aspect Plus. And then as we go out into the future opportunities, we believe those will be a blend really of not only acquisitions or bolt-ons, but potentially lateral hires, or indeed lifting a team or a small team out of another home and bringing them into the group. So, for example, within the M&A side, obviously, we've got the core brands. We've recently added market mapping. We see, for example, debt advisory as being a very nice adjunct to what we do there within the M&A business. We are, in fact, in discussions at the moment with a small team on the debt advisory side with a view to bringing them into the group. On the tax advisory side, obviously, Rand being the core brand and the core business there, Intax being the recent addition, and then services such as capital allowances and SDLT clearly fit very well alongside what we offer as a business. And equally, tax structuring is an area that both currently the M&A and restructuring business would outsource that work to third parties. So again, we are in discussions with a small team with a view to lifting them out of an accountancy practice and bringing them into the tax advisory business. On the restructuring side, obviously Quantuma being the core brand, recent additions of Alchemy and Aspect Plus, and we would certainly consider further bolt-ons in terms of London or other opportunities across the regions, and potentially areas like property and lease restructuring are quite interesting additions into the core service line of restructuring and insolvency. That brings us then round to the fourth quarter, or the other, as it's entitled there. We believe that this platform gives us distribution, and we can enhance that distribution through some of the things I'm going to talk about shortly in terms of the direct marketing skills, the cross-selling skills, and the accountants referral network, which we're currently in the process of building. And those three sort of additional areas of distribution, whilst clearly they can impact on the M&A, the tax and the restructuring business, there's clearly an opportunity for us to leverage those distribution channels to grow and accelerate the growth of other SME-focused businesses. So there's a number of areas that we're keen to explore in terms of additional services to SMEs that can be enhanced and distributed further through our direct marketing skills or indeed our accountants network. Okay, the next page really is to cover off some of the activity that we've been undertaking in terms of the integration of the 2 deals that we did last summer. And some of the key planks of our strategy that we talked about when we raised the funds to go and do these acquisitions were firstly our ability to cross-sell these services across group SME clients as a whole. Secondly, the establishment of the accountant referral network. Thirdly, the rollout of our data and volume direct marketing strategy. And fourthly, some of the softer integration and sort of cost saving and operational areas. So if we take each of those in turn, firstly, cross-selling. I mean, that was the most simple element of the strategy and the quickest and easiest to implement. And to date, we see K3 companies being the largest single introducer of work into the RAND business, currently accounting for 13% of the new clients that they've won within the period. So that's KBS and Quantuma referring existing clients into the RAND business. Equally for Quantuma, K3 group companies are the third largest introducer in the H1 period. And we've seen great cross-fertilisation across the two corporate finance teams. So that's the Quantuma Southern-based corporate finance team and the KBS Northern-based corporate finance team. With the sharing of buyers and such, we've been able to generate a likely fee of £220,000 from a fee that's due to complete at the end of February. In terms of the second area, the accountant referral network, as you perhaps know, our M&A business has been built on a platform of volume, direct marketing, and the data that sits behind that. Quite separately to that, both Rand and Quantuma have built their businesses on the back of referrals from accountants and other professionals. And when we acquired them, they both brought an existing network to the table. Rand had approximately 70 accountants and Quantuma approximately 330 accountants that were referring work to them on a regular basis. So what we've done is we've created a new brand called K3 Hub. This is essentially a membership referral organisation for accountants. It's typically aimed at small to medium-sized accountancy practices, so 1, 2, 3, 4 partner practices that often won't have the specialist advisory services that we offer as K3 within their existing sort of partner group. So, they won't have M&A, they won't have insolvency restructuring, and they won't typically have tax. So we bring new services for them to offer to their clients. So K3 Hub has been created alongside a website and a set of collateral for us to go out and present to accountants. We've apportioned around a 12,000 data set of UK accountants that we want to go after and present this service to. We've recruited 4 business development managers, 1 in the north, 1 in the Midlands, 1 in London and 1 in the south. And their task very much is to present these specialist advisory services that K3 offer and to grow the membership of that business. We launched that offering on the 1st of February following the tax submission deadline at the end of January, and great traction to date. We've signed up over 400 accountants so far, and those 400 accountants alone give us access to over 50,000 SMEs. So as they sign up as part of the membership process, we gain information about their practice and how many SMEs they represent. In the initial few weeks, access to over 50,000 SMEs. Our short-term goal is to build that to 1,000 accountants by our May year end, and upwards of 2,000 by next May year end. At which point we would have potentially access to over 250,000 SMEs through their trusted accountant, trusted advisor. So we see that very much as a distribution channel for not only our existing 3 service lines of M&A, tax and insolvency and restructuring, but also as almost a plug and play distribution for any new service lines that we might acquire, as I talked about in the previous diagram. From a direct marketing perspective, again, our sort of third key plank of strategy was to utilise and harness the strengths and the qualities of the M&A business and how it's marketed itself over recent years, and actually roll that out across the Rand and Quantuma businesses accordingly. Those of you that know us will know that our M&A business has been built on the fact that we have a fantastic UK SME data set that we invest a lot of time, effort and hours into developing and improving all the time. Equally, we have our own proprietary technology, which is called Globe, which allows us to access those SMEs and market our services at volume directly to UK SME business owners. We do that through a blend of telemarketing, email and digital marketing and pay-per-click, more traditional mail shot type marketing and a number of portals that we have. And it was our strategy that we would be able to harness those skill sets and technology, Globe and data system that we've built up over the years and roll that out across both the newly acquired brands. So by way of an update, in terms of RAND, we've created a new website, which is more optimized for digital marketing purposes and PPC. That was launched in January. We've duplicated our Globe system that allows the RAND business, therefore, to access a lot of the know-how and data and processes that have been built up over the years in the M&A business. We've recruited an internal sales team up in our head office in Bolton. And as of January, we've started to roll out that more volume direct marketing approach and hoping to significantly increase the client acquisition numbers into that brand. Equally, from a consumer perspective, we didn't want to direct market the consumer brand due to its close links to insolvency and the preference not to have the proverbial undertaker knocking on the door of UK SME. And we've created a new brand there, which is 180 Advisory, very much premised around turnaround, support, rebuilding and restructuring of businesses. Again, we've duplicated the Globe CRM system. We've created a new set of website and collateral, and we'll be looking to launch that in the coming weeks alongside the expected reduction or withdrawal of some of the government support measures that are currently undoubtedly propping up some failing businesses across UK SME as a whole. In terms of some of the softer integration and operational sides, this is really very much about playing to our strengths as a group of businesses. RAND, and we've seen the centralisation of the accounting and marketing function of that business that now sits under Bolton. From a consumer perspective, they had a particularly strong accounting function, so that function has remained in place and reports directly into Andy as CFO. Equally, consumer had a very strong HR and recruitment function and equally a strong compliance function. So we've decided to harness the strength of those across the wider group. So the consumer HR function is now supporting those wider group companies as well. Operationally, we have a lot of visibility through weekly management meetings with the senior teams of both businesses. We hold quarterly board and strategy meetings as you may expect. To drive forward some of the major projects and major areas within all the businesses. And as mentioned above, the bringing together of the corporate finance businesses, we've recently appointed Mark Lucas, who was former head of corporate finance for Consumer, and he now sits across corporate finance north and south as we develop and roll out that truly national corporate finance business. So hopefully that updates in terms of a lot of a very busy sort of 6-8 month period in terms of a lot of the work that's been going on to integrate these businesses and bring through some of the value that we were looking to when we initially acquired them. We now split out into the individual divisions and talk a little bit about the M&A division, the tax division, the restructuring division, and share a little bit with you around some of the trends in the KPIs and the specific financial performance of each of the divisions. In terms of the key highlights of the M&A division, I think the key positive here for us is the way that the M&A business has coped with the pandemic, the resilience, the robustness of its trading performance, despite those multiple regional and national lockdowns. So whilst, as we rewind a year, the original lockdown back in April to June last year caused almost a total pause on activity and transactions within the M&A space, the speed at which the M&A businesses have bounced back from that and the way that they've performed through subsequent lockdowns has been really, really encouraging. And I think that's evidenced in no better way than October, which was actually a record ever month for the business in terms of the number of new sales appointments that it saw and the number of new clients that it won. And equally, as we come down to the last bullet point there, more recently in H2 trading, January has been our most profitable month of the year to date. So the business continues to gather momentum and to bounce back to its pre-COVID levels far quicker than probably any of us would ever have envisaged in the early parts of the pandemic last year. So the way the people in the business from an operational point of view have transitioned to home working, the way that our sales staff have transitioned to online and remote selling has certainly been one of the key highlights. And brought around a lot of advantages in terms of meeting clients over Zoom versus driving around the country to meet clients has certainly brought some operational efficiencies as well. So our KPI activity has gathered pace from undoubtedly a slow start in June when we reopened the office and restarted the marketing and sales engine. Very much the KPIs have gathered pace since then and continue to gather pace as we go into H2. And we think this very much sort of corroborates what we've always said about the M&A business and the resilience of it. And we've always talked to investors about the spread of sector, of size, of geography, of enterprise value, the spread of motivations of our seller clients and the different types of buyers that we attract. The fact that we go out and proactively find these sellers on a daily, weekly, monthly basis, and how we utilize technology and data to help us source buyers for those businesses as well. And I think that that robust model that we've always talked about has certainly been borne out, and all of our revenues and profits in this period have come from the volume brands of the business, Knightsbridge and KBS Corporate, which certainly gives us a lot of visibility due to the fact that they're made up of many hundreds of transactions rather than the sort of low volume of high value transactions that we've historically seen through the corporate finance business. Our management team have performed very well in the period, haven't been distracted by what has been some quite significant activity in terms of the fundraise and the two acquisition processes or major acquisition processes that we've been through. From an operational perspective, the buyer demand, the way that we harness the technology to drive that buyer demand, the number of buyers and meetings and offers and ultimately transactions that we've seen through the operational side of the business has been astounding, to be fair, given the backdrop of the pandemic and what's been happening in not just the UK but the world at large. And to have seen the levels of activity that we've seen has been very, very encouraging for what we hope will come post-pandemic. And as I mentioned, strong start to H2. So despite the current lockdown 3 that we all find ourselves in, January has been our most profitable month of the year to date, and a strong indicator of hopefully what is to come in H2 and indeed as we go through into next year. I'll just pass you back to Andy to talk you through the financial side of the M&A business.
Here we have a bit more of a breakdown on the M&A side in terms of the KBS group. We have the two revenue streams within this business. One is retainer fee income and the second is transaction fee income. In terms of retainer fee income, if we think of this from the 1st of June, when we started the financial year, clearly we had all of our sales staff that had historically been 100% face-to-face meetings. They weren't able to do that because of the lockdown. So from a standing start, we were quite quickly able to get back out there with remote working. John will share with you some KPIs shortly that shows that revenue stream picked up very quickly, far quicker than we would have expected. In terms of transaction fee income, exactly the same thing. A lot of uncertainty under the first lockdown 1 last year, from both buyers and sellers and funders alike. Where the WIP pipeline, not something that we recognise, but the WIP pipeline that we have that sits pre-revenue, we were uncertain of delivering. However, again, from a standing start, we carried on completing transactions. In the 6-month period, we managed to complete as many transactions as in comparative periods, and clearly H1 FY20 pre-pandemic to be delivering the same during multiple national lockdowns, we're very pleased with. Overall, £5.9 million worth of turnover. There's a breakdown of overheads and costs here. As I mentioned before, we were quite quick to jump on our marketing spend. We were able to pause that very quickly over the initial lockdown and turn that back gradually as we started to see appetite come back. We started to push on doors to go out there and find clients to sell and equally find buyers to buy. And the same with our payroll. Whilst we've seen a natural reduction in staff numbers over the period, people leaving us, we've become far more efficient at what we do as we've moved to remote working and changed some of our business practices. I think it's important to note on here as well, it's been mentioned that we've repaid our furlough grants, which is correct. What that does mean, there was clearly quite a lot of people that were on furlough in Q1 as we're emerging from the first lockdown. Clearly those people have not been able to contribute to revenue. However, in repaying the furlough grant, they are on the payroll cost. Therefore, to still deliver £2.9 million worth of EBITDA and a 49% EBITDA margin, we think is a great result for the period. As John said, there's no significant corporate finance transaction fee income in this period. So all of this is built off a large volume of transactions, not reliant on anything in particular, which we think is fairly robust. And in terms of the EBITDA margin, as and when these corporate finance deals do drop into periods, we would hope that we would at least maintain, if not grow, this margin over time. If I pass back to John on some KPIs.
Yeah, what we're trying to show here, without without giving away any commercially sensitive information, is some of the key KPIs that, again, those of you that have followed us will know this, both on the sales and the operational side of the business. So what we show here is, in the bar chart, the last 3 H1 periods, with the current H1 period also showing the run rate for Q2 and how that has significantly outperformed H1 as a whole. So we're trying to show the improving trends following the initial impact of COVID and the lockdown last summer, when we furloughed much of our sales force, which is what impacts on these sales KPIs at the front end of the business. The second line graph then also highlights the impact of the initial COVID lockdown, and then some of across those major KPIs how it's recovered and how we've seen the trends since then. So from a sales appointments perspective, so these are the new clients that we're getting out to and pitching our services. Obviously, that's now screen to screen rather than face to face. It's therefore more efficient. We're able to do that with less salespeople. But you'll see there that there's a growing trend in the number of clients that we're presenting our services to. And you can see, obviously, that the bounce back from the original impact of the lockdown in the early part of last summer. Each of those clients that we go and see, we quote a retainer fee to. As we expected they would, the retainer fee numbers have dropped off by about 15 to 20%. Equally, the new client mandate numbers have dropped off by about 15% as well in the period. Not surprising to us at all, given what's been going on in terms of the pandemic. Quite pleasingly, however, our revenue numbers have only dropped off by about 10% based on current run rate there. So, I think this goes again to underline the robustness of the business and the fact that we've been out there proactively promoting our services and bringing clients to the market where there's been demand for them to require such services. On the operational side of the business, as I touched on before, some very pleasing stats in terms of the buyer activity and the number of meetings, offers, and ultimately transactions that we're doing. And you can see here that despite the COVID impact, buyer numbers have continued to increase H1 on H1 over the last 3 years. And in fact, this H1 almost 20% up on last H1, which seems almost astounding given, this H1 is entirely within COVID affected periods and last H1 was entirely outside of COVID affected periods. And we've always driven the volumes here in that the more buyers we find, ultimately the more buyer meetings we arrange. And again, they're marginally up in Q2 versus H1 last year. The more meetings we have, the more offers we tend to gain for our clients' businesses, which delivers great service to our clients. We're gaining more offers in Q2 than we were in H1 last year. And again, the more offers we get, the more transactions we complete. And again, whilst transaction fee revenue is down there on the period slightly, actually, the KBS and Knightsbridge brands have performed really well, and the number of transactions that we've done in the period is comparable with last H1, which again in itself is a great achievement. The difference there, the delta in the fee income, is just that in the last H1 we had some sizable corporate finance transactions which haven't come through as yet in this financial year. But overall, in terms of the M&A business, a quicker return to form than we'd ever expected. A really pleasing H1 period, H2 starting well, and a lot of confidence around the remainder of H2 and as we move forward into the following year as well. Okay, we move now onto the tax division. So the clear and obvious advantage of bringing this business into the group is that it diversifies our revenues into an area which sees high quality contracted and recurring revenues due to the fact that most clients are typically contracted for 5 tax years. Again, this business has proven to be robust, resilient, with strong performance both from a financial and KPI perspective across the multiple lockdown and office closures, etc. So we've seen good growth in KPIs, and we'll come on to that as we go into a later slide. Cross-selling has been an early highlight, as I identified in the earlier integration slide. 13% of new clients in the period coming from cross-selling from other group companies and providing that that service to KBS and Quantium clients. Equally, the rollout of the volume direct marketing approach is clearly an exciting advancement for the business, and one which we hope will add a lot of value as we go through H2 and beyond. We've got a really great team of motivated directors within Rand for people who run the business on a day-to-day basis, and they're properly incentivised with what we would term K3 style incentive schemes. So properly incentivised to drive the profitability of that business, and equally tied into the success of the overall group through the LTIP and the shares that they have. As I've mentioned, revenue and profits continue to increase, and Andy will talk you through the financials shortly. And as we touched on earlier, pleased to announce the acquisition of Intax earlier in the week in terms of starting to build out the service lines within the tax division. Andy, do you just want to pick up the financials?
Yeah, we've got the financials here. There's no direct comparatives for historics. There was a different year-end prior to ownership, and the management accounts weren't necessarily month by month. So what we've done to illustrate this is put the statutory accounts for the last 3 financial years. So revenue's grown from 3.5 to 4.2 to 4.3 million pounds over the last 3 financial years. We acquired Rand as a lockbox from the 31st of May. Therefore, there's a full 6 months in our H1 at PLC. So to deliver £2.6 million of revenue, I think comparatively that shows the run rates that we are going to continue the revenue trend and the growth. In terms of overheads and costs, very similar to KBS, it's a low operating cost base, operating from one head office in Derby, with a relatively small staff base that's grown slowly over time. What we see here is EBITDA historically going from 1.9 million to 2.0 to 2.2 million pounds in FY20. Therefore, to deliver 1.4 million pounds in the first half of this year, again, shows a run rate that's we would hope would continue and show growth into this year as well. Back to John, some KPIs.
Yeah, from a KPIs perspective, as mentioned earlier, we've seen good progress in most of the KPIs here. So the top left shows the average number of new clients that we're contracting on a monthly basis. That's grown 73% in the period, from 11 last H1 to 19 per month this H1. If we move to the right, average claims submitted to HMRC per month. And again, I'll remind you that Rand has an excellent reputation with HMRC, has a 100% success rate of claims submitted to HMRC coming through to fruition. And again, a 35% increase from 40 per month last H1 to 54 per month claims being submitted to HMRC in the current period. Our average fees are slightly down across the period. We're monitoring that closely and believe that partly down to a little bit of price pressure in the market, but equally down to the way that those clients have been generated, as the business, certainly through the pandemic, has shifted a little bit away from the more traditional trade shows where, whilst the cost of attending was quite expensive, they may have won some quite sizable clients, shifting more towards the digital side of things, which is a higher number of clients won, but typically a lower value of client. But equally, whilst the clients are of a lower average fee value, the cost of acquisition of those clients is equally lower, and therefore we're not eroding margin. In fact, quite the opposite. The EBITDA margin continues to improve to a rather impressive 54% in the period, up from 51 same period last year. So there's a lot of impact, we believe, yet to come on that business from the rollout of the direct marketing strategy and the build out of the accountancy network, but certainly a pleasing start to life as part of the broader K3 family. Move on now to the restructuring division. Again, clearly the insolvency sector as a whole has yet to see the increased demand which was initially predicted on the back of the pandemic, and sources, and depends which press you read, but sources would suggest that volumes of corporate appointments in the sector are probably down by around 30% in calendar year 20 versus the previous years of 19 and 18. So our own statistics show that whilst formal appointments have indeed seen a marked reduction, Quantium has been relatively stable in its appointment numbers and has therefore been improving its market share across the period. Market share actually from 18 to 19 to 20 has grown from 1.8 to 2.8 to 4.2%. That's Quantium appointments against the overall number of appointments in the market. So some pleasing market share gains, and equally to be seeing improving revenues and improving profits against a headwind of a minus 30% shift in the market is clearly an impressive statistic. We've continued to build the team, so through lateral hires and through the the two bolt-ons that we've mentioned, we've continued to build both the fee earner base and the staff base that sit beneath that, in terms of continuing to grow that capacity that sits within the Quantuma business. Quantuma also incorporates a forensic accounting and investigations business, and also the corporate finance business that we've talked about, and both of those are having and continue to have a successful period, improving their contribution towards the overall Quantuma revenue and profits. And as mentioned earlier, we're delighted to welcome the Aspect Plus business into the Quantuma fold, and equally delighted to expand our international footprint with the acquisition of Alchemy in the Cayman. I think from a point of view, when you buy businesses, always a fear within those businesses that there may be, centralisation of departments and cutting of people and staff, etc. So I think it's great as a whole across the group for those businesses to be seeing that we recognise that some of the functions within those businesses are best in class, and are therefore using them across the group as a whole. So as mentioned earlier, the HR and the compliance functions of RAND, and being able to leverage the value of those functions across the wider group is certainly an advantage that we didn't necessarily envisage at the outset. But the key element here really is that by having this restructuring division now as part of K3, it gives us that counter-cyclical balance, and helps build that stable platform from which, as we touched on earlier, we can go out and build a significant professional services group. I'll just pass you back to Andy to again run through those financials in a similar format.
These financials quite similar to RAND in that Quantuma had a different year end historically and different quarter ends, therefore no direct comparables. However, what we've done is use statutory accounts to show the last 3 years' revenue, growing from £11 million, £17.3 million and £23.2 million in FY20. We acquired Quantuma from the 1st of August, therefore there's 4 months within our half year, and we've delivered revenue of £9.3 million, which is a simple run rate, shows that we are looking to continue that impressive growth curve. As with KBS, there's no significant fees within here. This revenue line is made up of hundreds, if not thousands, of small transactions, and no reliance on any one particular individual or client to drive that forward. In terms of EBITDA, historically, this was an LLP, so we've normalised these numbers with partners' salaries as opposed to drawings. That would have equated to somewhere in the region of £2.2 million EBITDA in FY18, going to 3.3 million in 19 and 4.5 million in FY20. A very different cost base to the rest of the group in terms of the number of offices that we've got and the headcount. However, still with 7.2 million pounds worth of overheads, the 4-month period has delivered 2.1 million pounds worth of EBITDA pre-PLC costs. And again, the simple run rate suggests that we're in line to continue the impressive growth rate that we've seen over the last few years. I'll pass you back to John on some KPIs.
Yeah, just to show you some sort of quite interesting statistics about the market and how Quantuma has performed within that market. So this references back to what I was talking about before around the fall off in insolvency numbers due to the government support measures put in place throughout the pandemic. Insolvency numbers in 2020 dropped to 12,600, down from about 17,500 in the 2 prior years. Quantuma adversely have been able to continue their growth, as they've grown their staff base, grown their office network, and grown awareness of their brand within the market. They've been able to grow the number of appointments and in turn grow market share across the period. And as I said before, growing from 1.8 to 2.8 to 4.2% over the last 3 years. A part of that's been driven by growing the staff base and fee earner base of the business, as we talked about before. And we can see there the statistics of total employee numbers going from 135 in 2018 to 175 last year to 225 at the end of the period. And again, fee earners growing in line with that as well. I think importantly also to point out, we've always presented quite a prudent approach to accounting across the M&A business, and that certainly is our approach moving forward. What we see here is our work in progress as a percentage of revenue. And you can see from this that, again, these are calendar years rather than financial years, but to give an indication, our WIP typically running at high single digit, currently running at 10% of our revenues, 2.4 million versus 24 million of revenue last year. Again, this compares very favourably with not only some of the businesses that we've looked at in terms of potential acquisition targets, where WIP values have been, sometimes approaching 100% of annual revenue, but even our listed competitors can typically be at 35 to 45% of revenue as WIP. So, from our point of view, a very prudent approach, which lends itself well to the cash conversion of the businesses that we have across the group as a whole. Just pass you back to Andy now to talk a little bit more detail on the financial statements.
It's quite a lot more detail in the financials. I don't propose on going through it in great detail, more an exception report. In terms of the profit and loss, clearly we've talked about revenue of £17.8 million and EBITDA of 5.6. Aside from that, there's been some significant changes from the last time we came out reporting. Clearly, amortization of intangible assets with the acquisitions that we've made. There are fair values placed on things like client contracts, so I would expect amortization to continue over the coming years. Again, not a cash item. In terms of finance costs, as it stands, we are debt-free as a business. All of this relates to essentially the contingent consideration, the earnouts that's been placed, or the value that's been placed on the earnouts of Consumer and Rand. So not necessarily a cash item in the period. That's why we're showing a headline EPS number as opposed to the basic. That effectively strips out these exceptional items or non-cash items. Whilst the comparative period had fewer shares, with circa 42 million in circulation as opposed to the 68.5 million now, the headline earnings per share has grown from 6.3 pence to 6.9p, which I think demonstrates the strength of this enlarged group. Again, some significant changes on the balance sheet from the last time we presented, all because of the acquisitions that we've made. No surprise to see a significant increase in intangible assets. In terms of trade receivables and trade payables, both businesses that we've acquired, we have done so on a cash-free, debt-free basis, but with normal levels of working capital. So all these receivables have come in and have been factored in as part of the purchase price. The other main changes here, the contingent consideration. So whilst there's circa £15 million on here for the next 3 years, all of that is linked directly to the performance of the subsidiaries and are largely self-funding, as we've talked about cash generation in the past. So overall, £47 million on the balance sheet, if we exclude the deferred consideration, debt-free. We've talked about the WIP policy for Consumer, which we believe is highly prudent. And the same with KBS, in the sense of no transaction fees going to WIP until they've actually completed. We see this as a very robust balance sheet and with very prudent accounting policies. Finally, on cash flow, I think most of this is self-explanatory. As mentioned at the start, the fundraise that we did over the summer, we used that cash swiftly and decisively to make the acquisitions. We see those funds flowing in and out. The slight difference in numbers here with Rand and Consumer. Rand was acquired with a vendor placing, so shares were issued and placed direct with the vendor. That's why there's a slight discrepancy. However, what this does show is high levels of cash generation, finishing the year with £10.1 million of cash, something that we expect to be relatively stable over the next 3 years, whilst maintaining high levels of dividend payouts and equally paying the earnouts that we've agreed to over time. Back to John on the current trading and future outlook.
Yeah, I mean, in terms of, we've touched on some of this, but clearly myself, the board, extremely satisfied with the group's performance during H121, and certainly from our point of view, expecting full year earnings to be comfortably in line with market expectations. As we've touched on the M&A business, a quicker return to form than we previously envisaged, and really happy with the way that the business has reacted and bounced back from the pandemic. H2 again commenced well, with January being profitable, the most profitable month we've had in the year so far, and February equally is holding up very well. The tax business is obviously more steady, contracted and recurring revenues, but again, our excitement there really comes from the rollout of the accountant referral network and the direct marketing strategy, and how that can continue to fuel that growth moving forward. From a Quantum perspective, as we touched on in those previous slides, strong performance in the face of negative 30% headwinds in that market as a whole, which is really pleasing to see. And as a board, we're really optimistic about the additive effect of the joint venture, the bolt-ons, the smaller deals that we've done, and the lateral hires that we've added and brought into the group since we did these acquisitions last summer. So a lot of confidence around H2 and indeed beyond. And we really feel like we now have a stable, diversified group that has the cyclically balanced revenues that we've perhaps not had in the past as a pure M&A play. And we've created a very robust model with a greater degree of visibility and predictability than we've ever had before. In terms of future acquisitions, we do continue to evaluate complementary acquisitions, both ones that have come to us themselves and equally ones that we've proactively gone out and looked at through our market mapping offering. We are currently considering a debt facility. The group has previously always been debt-free, but we are currently considering a debt facility in the order of 10 million to really provide a bit more flexibility around the potential funding of such acquisitions. And just back to Andy to finish off on dividend policy, and then we'll move to some questions.
Dividend policy, I covered at the start of this, but just to reiterate, we're now moving to a fixed dividend policy. The interim dividend for this year will be 3p, and that will be paid on the 17th of March. The overall dividend for the year is expected to be 9.1p, rising to 12.1p and 15.5p over the next 3 financial years, which shows our commitment to this progressive dividend policy.
Fantastic. John, Andy, thank you very much indeed. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I hand back to the K3 Capital team, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. John, Andy, perhaps before we look at the questions submitted during today's presentation, we did have one pre-submitted question. I think you have covered this off during the presentation, but just in case there is any further colour to add to it, if I could just read it out. Noting the increase in administration costs, can you give a breakdown of these and give a forecast of expected levels going forward, assuming steady state, i.e. no new acquisitions?
Yeah, I think the individual slides hopefully have covered that question. We've shown the breakdown per the different divisions. I think we've given a bit of a backdrop as to what's happened in terms of reductions in costs of the M&A business and equally where we expect to go going forwards. Clearly, we can't give forward-facing numbers, but there are broker notes out there that have got some expectations. As I say, I think we've already covered that.
Fantastic, thank you. I know I haven't given you perhaps a long time to have a look through the questions, but if I could just direct you guys to the Q&A tab just situated on the right, and perhaps we could just start at the top, and if you wouldn't mind reading out the question and who it's from and your response where appropriate to do so, thank you.
Yeah, sure. First question I've got here is from Nick J. It says, what split or balance are you aiming for between repeating revenue versus the more spot fees? I presume from that, Nick, what you're getting at is the sort of the recurring revenue versus the more transactional revenue that we see in the business. I mean, the reality is that the M&A business, whilst many would see M&A as being transactional, which clearly it is, I think our M&A business is slightly different in that it has a high degree of repeating revenue through the retainer fees that our clients pay us at the front end of the process. So there are 2 revenue streams, the front end revenue and the transaction-based success fees at the back end. So a lot of that, because we're working across the hundreds of transactions in the Knightsbridge KBS corporate brands, we are seeing a good visibility of that revenue repeating on a weekly, monthly, and annual basis. So there's a good stability to that, which is quite different than the sort of the fluctuating side of the corporate finance business, which can be a little bit lumpier. I mean, the R&D business ultimately is the only true recurring revenue that we have because those are 5 tax year contracts with our clients. and obviously as we look to build the group out further, a greater shift towards contracted, recurring, and repeat revenues is certainly something that's important in our minds, and we would like to see that balance move more toward that as we go forward. But ultimately, we want all three brands to grow. We want to be additive to them in terms of the additional service lines and the additional routes to market, and build all accordingly. But hopefully that answers the question. Next question is from Christian H. John, lots of encouraging updates which are well articulated. Thank you, Christian. Please can you talk regards the competitive landscape, particularly for the new businesses of Brand and Quantuma? There's a second part to the question that I'll come on to. But yeah, in terms of competitive landscape, I think very much like the M&A business that we've been in and that is our heritage, both of these new businesses are operating in extremely fragmented and competitive marketplaces in their own right. In the M&A business, we've always competed with a huge range from your back bedroom broker and your small regional or sector specific player, competing with accountants, right through to top 20 big four, and lots of different shape, size and nature of competitors across the M&A business. And I think that exact same argument applies for both Rand and Quantuma. In the R&D space, you've got tax divisions within your big four and your top accountancy firms. Equally, you've got some smaller, what we would term sort of back bedroom tax specialists that are doing exactly the same sort of service. So it's a very similar competitive landscape. Equally, in the insolvency and restructuring side, obviously there's a lot of issue, if you like, around at the moment in terms of the large accountancy firms and the conflict that comes with them in terms of their own restructuring and insolvency businesses, but they all have them. Equally, a lot of your medium-sized firms do a fair amount of this work as well. And then there's the listed and smaller competitors, the likes of FRP, Begbie's, etc. So all three businesses operate in competitive landscapes. I think where we differ and what hopefully we bring to the table in terms of our future growth is these distribution channels, and the fact that the ability to cross-sell across the group, the ability to leverage the accountant referral network as we build it, to refer clients into all group service lines, and the ability for us to roll out our data tech-driven volume direct marketing approach is something a little bit different and that others don't necessarily have. So we certainly feel that gives us a competitive advantage. Second part of your question, Christian, M&A deal flow, please can you provide an update on conditions, in particular any sector considerations given the COVID backdrop? I think we've always set our stall out in the M&A side to be sector agnostic, Christian, and we work across all sectors, all sizes, all geographies, all buyer types, be it PE, trade buyers, individual or private buyers, MBO, MBI teams, EOTs, family offices, overseas, UK, etc. So we are a very, very broad church. In terms of COVID, clearly some businesses have been affected very negatively through that, and some businesses equally have been affected very positively. And we've seen transactions that have fallen away because businesses have suffered throughout that COVID pandemic. Equally, we've seen transactions come to the fore because maybe they are tech or web-based businesses where actually their businesses have picked up significantly during the pandemic. So there's been, as there always is in these situations, there's been winners and losers from that point of view, and we've seen that coming through into those particular transactions as well. But across the piece, we're just delighted that the M&A business has bounced back at the rate that it has, and that we've concluded, as we said earlier, as many transactions in H1 as we did in H1 last year, which clearly is an impressive statistic given the turmoil that's been going on in the market as a whole. Next question is from Simon C. Is the current environment making smaller self-funded acquisitions of businesses or lateral team hires easier? And what should we expect in terms of size of acquisitions moving forward? Thanks for that, Simon. In terms of acquisitions moving forward, as I hoped we sort of tried to display through that wheel, we really see this as a blend of lifting teams, lateral hires, small bolt-ons, and then potentially moving into some more sizable acquisitions equally as we go forward as well. So there's no particular focus on any one of those. It really is a blend of all of them. Is the current environment making these easier? I honestly don't know the answer to that. I think what we've shown is that we've been able to do them. So, we've done the 2 sizable acquisitions, 3 smaller acquisitions since, a good number of lateral hires. I think what we're finding is that people are attracted to our story. The way that the PLC has gone out and developed and grown through these acquisitions, has diversified. And obviously the advantages of being a PLC in that our ability to issue growth shares and attract people through quite clever remuneration and share-based packages, it certainly seems to be proving attractive. The culture of our business and the way that we work again seems to appeal to a lot of these people that are coming to the fore. So from our point of view, watch this space. We're certainly live with other conversations, and we do expect to see more activity in all those areas as we go forward. Next question, which I think is the last one currently, from Abby R. Do you expect the insolvency division will see a dramatic rise as we come out of the government-funded schemes that businesses have received during COVID? Yeah, I think, Abby, there's a lot of press, certainly there's a lot of commentary on at the moment around the, I've heard phrases like a tsunami of insolvencies, a tidal wave of insolvencies, that, that the government are supporting zombie businesses that absolutely would fail otherwise. All of which ultimately is quite sad for UK SME. But clearly as a business now, what we have is a group, and within Quantum and the insolvency business is a business that can take advantage of any uptick that comes in that activity on the back of any withdrawal, reduction, or whatever it might be of government support. We're certainly not budgeting or building the business on the back of this tidal wave or tsunami. What we're doing is we're adding to the mix through these lateral hires and these bolt-ons, and we're building the capacity of the business as Quantum always has done over its years of growth since 2013 when it started. And we certainly believe that there will be probably a return to more normalised levels of insolvencies as we go through the rest of this year and beyond. Whether that ultimately comes through to an acceleration of those numbers, your guess is as good as mine. But we're monitoring it. We're conscious of it. We're building for the future, but we're certainly not building around being too optimistic about what might come there. Another question just come through from John D. Firstly, thanks for a comprehensive presentation. Thank you, John. Has any thought been given to rationalising Quantum's office network, given the M&A division and RAND, each operating from a single centralised hub? Yes, John, that is something that we've discussed. In reality, Quantum has an office network. It has leases in place, and it has people located throughout that office network across the UK. We certainly have no desire to become an operation such as Begbie's maybe that has 65, 70 offices across the UK. It isn't our intention to have an office in every town and every village. That being said, we do think that a national network of offices is an advantage to us, and equally that we might be able to leverage some of that network to give us benefit into the other 2 businesses as well. In that, we, in normal times, a lot of it's screen to screen at the moment, but in normal times we go out and attend a lot of face-to-face meetings with our clients in the M&A division, for example, and the ability to be able to do that in a discreet and private office location of Quantum's rather than perhaps in the place of business of the clients, does potentially have benefits across the wider group as a whole. Clearly, we're monitoring the situation in terms of offices. We're learning. We've got a hell of a lot of people working from home at the moment, and a lot of our offices sit partially full, or indeed some of them empty at the moment. So it's not something that's totally escaped our thinking, but certainly we have no plans at the minute to start closing offices. Although clearly going forward, perhaps less office space and hot desking and shared desks. Therefore, reducing office costs is something that potentially might be on the agenda. Hopefully that answers the question. I think, Paul, that's it in terms of
questions.
questions.
I was just going to say, I think you've addressed all those questions that have come in from investors. So thank you very much. And of course, if any further questions do come in, the company will review those questions and publish responses where it's appropriate to do so. John, perhaps just before we direct investors give you some feedback, a last couple of words just to wrap up, please, if possible.
Yeah, sure. I mean, hopefully you've seen here that the business has changed significantly since our last reporting period, and hopefully the presentation has been complete and has given you now a good overview of the 3 divisions that we have currently, how we plan to build those out, and indeed the opportunities for additional scale through other acquisitions in other areas as well. Hopefully we've talked to you about the distribution and how we plan to do that. And certainly, from an internal perspective, both within the head office function, the PLC board, and also the brands as a whole, we're hugely excited as a senior team about not just what we've created so far and what we've achieved in H1, but what we can go on achieving in H2 and in the years to come. So, from our point of view, we're creating a platform now that gives us the ability to go out and scale something pretty significant. And I hope that the presentation has given you a lot of information around that. So, thank you for attending. Thank you for listening. And certainly, we welcome the opportunity to talk through this platform to more private investors as we move forward through the hopeful success story that's to come. Thank you for listening.
Fantastic. John, thank you. Andy, thank you very much indeed. Thank you for updating investors today. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback form will pop up in front of you. If you've accessed the meeting via the link sent you in an email, you'll just be asked to log in. If you do take just a couple of minutes to give the company feedback, it'd be very much appreciated. On behalf of K3 Capital Group PLC, we'd like to thank you for attending today's meeting. Thank you very much. And that concludes today's presentation. Good evening.